Welcome to Ownership Models Explained, a new series from Ethical Exits sponsored by Steward Market. Every business has an ownership model, and every ownership model has incentives, and every incentive creates trade offs. In this series, we'll break down the structures shaping business ownership without the jargon, the hype, or the ideology. Today, is private equity actually bad? Let's start with a company you've definitely heard of. When Red Lobster filed for bankruptcy in 2024, private equity was blamed almost immediately. Headlines painted a familiar picture: another beloved company destroyed by Wall Street. And certainly there's some truth to that story. Private equity ownership, significant debt, and strategic decisions all played a role. But they weren't the whole story. Red Lobster had also been struggling with declining customer traffic, changing customer preferences, rising labor and food costs, and that famous endless shrimp promotion that reportedly cost the company millions. And Red Lobster isn't the only headline. Toys R Us, Party City, Joann, Big Lots, different industries, different leadership teams, different market conditions. Some struggled because of e-commerce, some struggled because of inflation and higher interest rates, and some just because consumer habits fundamentally changed. And in several cases, analysts argued that the debt used to finance those leveraged buyouts made those companies less resilient when adversity arrived. So, was private equity indeed the villain? Or was it one factor in a much more complicated story? Well, I think we're asking the wrong question. Instead of asking whether private equity is good or bad, I think we should ask, what is private equity designed to optimize for? But before we answer that, let's ground this conversation in data. So, private equity firms now manage more than 13 trillion in assets globally. The typical buyout investment is held for just 4 to 7 years. Academic research following nearly 500 leveraged buyouts found that about 1 in 5 entered bankruptcy over a 10-year period. Yet, despite those headlines, private equity remains one of the world's largest and most influential ownership models, with institutional investors including pension funds, university endowments, and charitable foundations continuing to allocate hundreds of billions of dollars to this asset class every single year. So, why do smart investors continue to invest? Because, frankly, private equity can also be remarkably effective. Every ownership model has a purpose. Employee ownership often optimizes for broad-based employee participation. Family offices frequently optimize for long-term ownership and flexibility. Strategic buyers optimize for synergies and market expansion. Private equity is designed to maximize financial value creation over a defined investment period. That doesn't make it unethical. It simply creates incentives. Those incentives often lead firms to invest in technology, recruit experienced leadership, expand internationally, acquire competitors, professionalize operations, or provide founders with liquidity while helping businesses continue to grow. So, to be fair, many companies become stronger because of those investments. In fact, companies like Hilton and Dunkin' passed through private equity ownership before emerging as significantly larger businesses. Those stories rarely become headlines because successful turnarounds aren't nearly as newsworthy as bankruptcies. But incentives also create trade offs. Private equity isn't a personality, it's a financial structure. And financial structures create incentives. One of those incentives is leverage. A leveraged buyout uses borrowed money to acquire a company. When things go well, debt can amplify returns. Debt can be a good thing, a healthy thing, a necessary thing. When things don't go well, debt amplifies risk. That's why researchers found bankruptcy rates significantly higher among leveraged buyouts than among comparable public companies that weren't acquired in that way. This doesn't mean private equity firms are worse operators. It means they're often operating with a different capital structure. Think about it this way. A Ferrari isn't a bad vehicle because it can't haul lumber. A pickup truck isn't a bad vehicle because it loses on the racetrack. Of course, those two cars were just designed for different jobs. Ownership models work exactly the same way. If your highest priority is maximizing enterprise value, accelerating growth, and creating liquidity, private equity could be an excellent fit for you. But if you're equally concerned about preserving your culture, protecting employees, remaining locally owned, maintaining your mission, or ensuring long-term independence, then those priorities deserve to sit along price in the decision. Because here's the part I think every founder should understand. A private equity firm can have an incredibly successful investment, while the founder walks away wondering whether the business they spent 30 years building still reflects what they hoped it would become. Those aren't contradictory outcomes, they're simply different definitions of success. And that's really the point. At Ethical Exits, we don't believe there's one perfect ownership model. We believe that there are ownership models optimized for different outcomes. So the question isn't who will pay the most. The question we ask is, what is this ownership model designed to optimize? And is that what I want to protect? Because ownership isn't just about who signs the check. It's about who writes the next chapter. Thanks for listening. We'll see you next time on Ownership Models Explained.